There is this popular clip of Nithin Kamath, founder and CEO of Zerodha, talking about how stop losses are not the solution to everything. Let's break it down and understand what he means.
Stop losses are sold as this solution to all problems, which isn't.
Okay. First, let's understand what a stop loss is. A stop loss is a tool that investors and traders use to limit their potential losses on any trade. It's essentially an order you give to your broker to sell a security when it reaches a certain price lower than the price at which you bought. For example, if you buy a stock at 100 rupees, you might set a stop loss at 90 rupees. This means that if the stock price drops to 90 rupees, your shares will be sold automatically to prevent any further losses. This helps you manage risk by capping off your potential loss if the market moves against you.
If you're putting stop losses too tight, if you're putting too many stop losses, you're getting triggered on too many stops, that means the strategy itself is quite wrong.
Okay, let's understand what putting stop losses too tight means. Basically, it means that you're setting the stop loss orders very close to the current market price of the security. For example, if the stock is at 100 and you set the stop loss at, let's say, 98 rupees, while the intention is to minimize a potential loss, if the stop loss is set so close to the current price, it could be triggered just by normal market volatility, causing you to be exited from your positions prematurely. This essentially means that your shares are sold automatically because if the usual ups and downs of the market. This could result in you missing out on potential gains if the price moves back in the favorable direction that you want it to.
That whole stop loss, put a stop loss, put a target, it's oversold because for everyone who is selling a stock tip, it's a way to cover their ass. That's about it. Right?
This means that if someone gives you a stock tip and also recommends a stop loss, if the trade goes poorly, they can point out at the stop loss and tell you that that was a safety measure at place, thereby deflecting the blame from the bad outcome.
But it doesn't work like that. Make sure your stop losses are not so tight that you keep hitting it.
Again, this point here is important. If a stop loss is triggered too often, it could imply that it's set too closely to the market price. A stop loss should give your stock some breathing room for normal market fluctuations to invest.
This is a mistake I did as a trader, and this is a mistake that happens even today, right? Because we are constantly fed this information everywhere saying stop loss, and but the thing is that leads to overtrading, and overtrading is really the biggest reason for people to lose money.
Finally, we come to the point. Overtrading means buying and selling stocks too frequently. It can be expensive because the transaction costs of each trade add up, and it's often the sign of impulsive trading without a clear plan and a strategy in mind. And overemphasis on stop losses can lead to overtrading, as one will quickly sell their stocks as soon as they hit their stop loss, and they might buy again when the price seems better, racking up fees and possibly losses also along the way. In conclusion, one needs to take a much more nuanced approach to using stop losses. Stop losses aren't bad, but they shouldn't be used as a part of the day-to-day trading as well. A well-considered strategy is the solution to the problem. The key takeaway here is to understand that while stop losses can be useful to manage risk, they should also not be overused or set too narrowly without considering the overall trading plan and the market condition. Remember guys, trading stocks is very risky. If you're not good at it, you should not be doing it at all. You need to understand the market, and without the understanding of the market, it's easy to lose money instead of making it. In fact, less than 1% of active traders earn money that is more than the bank fixed deposit over a 3-year period. The best way to stay out of trouble is exactly what we discussed earlier, that is not trade too much, and for that matter, don't trade at all. If you want to make some money from stocks without taking big risks, a good idea is just to buy and hold stocks that you believe in for the longer run. This way, you can earn more money from the growth and not pay up the fees as well as not incur the losses. All of this invested over many years usually is a much safer bet than making quick cash from constant trading. Plus, you'll worry less about the ups and downs of the market. That's it for this one. Subscribe to Wealth Bites and I'll see you in the next one.